private businesses make up almost 2/3 of the investable U.S. market. So accessing private markets is crucial for a truly diversified exposure to the U.S. economy.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. Today, we take a closer look at one of the hottest topics in the retirement space today, private equity and 401k plans. This is something I know a lot of people in the defined contribution space are skeptical about, so we want to look at it today from more of a private equity point of view. Following President Trump's recent executive order on democratizing access to alternative assets for 401ks, advisors and plan sponsors are asking what this increased access to alternative investments could mean for participants, fiduciaries, and the broader defined contribution market. To help break it down, we're joined by Neuberger Berman's Maura Reilly Kennedy and Michelle Rappa. Neuberger Berman is a private, independent, employee-owned investment manager founded in 1939 with a focus on delivering compelling investment results for its clients over the long term. Maura Reilly Kennedy is a managing director of Neuberger Berman and a senior member of the private equity investment team. She focuses on designing, implementing, and managing customized, commingled, and registered private equity solutions for clients. Michelle Rappa is a managing director and client advisor at the firm who is focused on formulating and executing the firm's overall defined contribution strategy and promoting institutional DC investment capabilities. Michelle also happens to be a founding board member and current chair of the Defined Contribution Alternatives Association, a nonprofit dedicated to educating stakeholders and advocating for the responsible inclusion of alternative investments in defined contribution retirement plans. Maura and Michelle, welcome to the 401k Specialist Podcast.
Thank you, Brian, for having us.
Yeah, thanks, Brian. Thank you for having us.
All right. Well, the Trump administration's recent executive order has drawn a lot of attention. Maura, let's start with you. What's the big picture view on why this is potentially such a significant development for retirement savers?
So I'd say we agree. The executive order is a significant development in broadening access to alternatives for retirement savers. And while the executive order itself, along with the recent withdrawal of the Biden-era guidance, are important catalysts, lasting change will depend on formal rulemaking and ideally congressional action. So, in other words, it's an important first step, but it's not the finish line. And what's particularly noteworthy is that the executive order puts this issue squarely on the regulatory agenda. It's a clear call to action for both plan sponsors and asset managers. It's as if the starting gun has gone off for a new era in retirement plan investing. And now it's up to all of us to figure out how to make this work in practice. From a practical standpoint, the order gives the DOL 180 days to take action, which signals a real commitment to moving forward. And we're expecting the DOL to issue additional sub-regulatory guidance within the timeframe. And they also may propose clarifying regulations. And this would be a welcome outcome for retirement savers who want more choice and flexibility in their plans.
All right. Well, now all the hard work begins. So, as we mentioned in the intro, your firm, Neuberger Berman, was a founding member of the Defined Contribution Alternatives Association. Michelle, can you talk a little bit about the association's role in shaping education, advocacy, and best practices for alternatives in DC plans?
Sure, Brian. Very proud of all the work that DeCalta has done over the years. We actually just celebrated our 10-year anniversary this past July, and excited about, really focusing the entire time on educating plan sponsors and regulators on the value of alternatives in defined contribution. We've seen defined benefit plans, endowments, and foundations all investing in private markets, and defined contribution plans just really not taking, any stake or opportunities in that section of the market. So DeCalta really has tried to release different pieces and, in fact, different papers that go to the different alternatives and how you can use them, and try, if I take a step back, we started with 6 people around a table. And now it's up to about 60 different firms that are involved. And it goes across, DeCalta's really across the entire industry of defined contribution. So there are asset managers there. There are private asset managers there. There are technology firms there. There are record keeping firms. There are consulting firms. So really all the different participants in the ecosystem are involved in the conversation and trying to say, how does this work for DC plans? How do we make sure that you have the right operations, the right vehicles, the right way to deliver this to participants? We recently put out a paper, the DeCalta Principles paper, which talks about adding alternatives for fiduciaries, all of the things that they need to think about. And then there was also a private credit paper that just came out. And before that, papers on valuation, liquidity. So really this formal process of thinking about education. And we're hoping in 2026 going forward that we can continue that educational program across the industry and including collaborating with some other associations to make sure that the message that's getting to plan sponsors and regulators is consistent across the industry, and that we're really coming out with a unified voice.
Mhm. All right, Alta. I was never sure until now how to pronounce that acronym. It's been well documented that defined benefit plans have long benefited from private equity and other alternative allocations. Maura, what lessons from the DB world are most relevant to DC plans today as they consider integrating alternatives?
Yeah, I mean, it's right. And it's kind of shocking that despite the success that DB plans have had with private equity and other alternatives, almost none of the $12.5 trillion of DC assets are invested in private markets. And DB plans have, as you said, proven that private assets can boost diversification and returns. From diversification perspective, kind of private businesses make up almost two-thirds of the investable US market. So accessing private markets is crucial for a truly diversified exposure to the US economy, for example. Or we've also seen value creation shift. So companies are staying private longer, and much of their growth happens to be before they ever reach the public markets. And then, from a return perspective, over the long term, we've seen private equity outperform public markets, especially those top quartile funds. So, to your question, kind of what's holding DC plans back? The traditional private equity structure is complex. If you think about capital calls, long lockups, administrative headaches, those all make it tough. And then on top of that, DC plans face additional regulatory and litigation risks. But the good news is the industry is evolving, and innovative structures like evergreen funds are helping to solve many of the operational issues and eliminating a J curve. They offer that immediate capital deployment, flexible liquidity, and the ability to add more capital over time. And then there's also DC friendly wrappers like collective investment trusts or CITs or other fund structures that make private equity more accessible and palatable for DC investors. So while there are still challenges, right, like in everything in life, there are inherent trade offs, we're seeing real progress. And I think the lessons from the DB world are highly relevant as DC plans look to embrace alternatives, but importantly, in a way that works for their plans and their participants.
Right. It's going to be interesting to see all these new different product types, how they work it. Now, Neuberger Berman's research suggests that adding a 10% allocation to private equity within a target date fund can significantly improve retirement outcomes. Michelle, can you briefly walk us through what the research found and what kind of impact this could have for retirement plan participants?
Sure. So what we did was we took two glide paths and we wanted to take a look at how a glide path would perform with traditional asset allocation to publicly traded equities, active equities we did use. And then how would it perform if we added a second glide path and said, if we add a 10% allocation, as you said, to private equity, what does that do to the performance? We did model the glide path based on assumptions from a typical glide path that's out there. We're not a glide path manager, so we didn't want to change the allocations. And we did use our own forward looking returns with also the demographics of your average participant in there. And what we found when we took a look at it was that first, in terms of strategic diversification, private equity really improved both the risk and the return of the target date fund. And then secondly, we said, okay, well, what does this, do to someone's wealth accumulation in the target date fund? And we saw that the returns increased anywhere from 63 basis points to 93 basis points for the target date fund that had the private equity added in there, that 10% slice. We also looked at that according to Monte Carlo calculations and said, okay, well, in the 90th percentile, when everything's doing well, of course it did well. In the median case, the target date fund with the 10% allocation did better. But even in the 10th percentile, the worst case scenario, the target date fund that had private equity did better, had a better outcome. And we really thought, at first I thought maybe we'd see that the risk would make it not have a better outcome. But what it really shows is that you're not adding risk when you're adding private equity. What you are getting is the illiquidity benefit. So that is actually, that was a good finding. And then third, we found, the ultimate goal of participants is your retirement income. And so you take that higher ending wealth and we bought a life annuity with it. And we saw with that could boost your income in that life annuity by 19% more a month, which means that a participant that would have had about, a little bit over $3,200 would with private equity have a little bit over $3,900. And Brian, if you think about that, that's $600 more a month, and where your average participant might not even have $500 in emergency savings. If you think about that conversation, so having $600 more a month from your annuity could be life changing.
Wow, that's interesting. Okay. Critics of adding alternatives or private equity investments into DC plans say that they're too illiquid, they're very complex, and they have higher fees. Maura, now, how do you see alts being structured within the workplace retirement plans in ways that can alleviate some of these concerns?
Those concerns are valid. Lack of liquidity, complexity, higher fees. It's made investing in private equity a real challenge for DC plans. Historically, private equity has been tough to fit into the confines of defined contribution plans, and because of the reasons that you mentioned, and also a bunch of the reasons I mentioned before. But what I want to emphasize is that things are changing, and there are innovative structures out there that are making these investments more accessible and practical for retirement savers. The fee pressure in DEC plans is intense, and private equity is typically the most expensive asset class in the mix. So, plan fiduciaries must ask, what am I getting for those higher fees? And that's the right question. And our research, as Michelle just summarized, shows that the return and diversification benefit associated with the addition of an allocation to private equity do far outweigh the additional cost. But ultimately, it's about making informed decisions that align with the long-term interests of plan participants, taking into account both the opportunities, but importantly, also the risks.
Okay. Now, Michelle, beyond accumulation, how can private market allocations improve the retirement income side of the equation? Things like annuity streams or drawdown strategies.
So as we just talked about, Brian, our research showed that with a private markets allocation and a target date fund, you can get to a higher ending balance. And then if you just take that and buy a traditional annuity, you can get a better annuity stream. But if you think about what's going on in, the retirement market right now, there's all sorts of retirement income solutions being developed within target date funds. So if you think about putting private assets into that target date fund and then having a retirement income solution that's getting you to better institutional quality annuity income stream, you could probably get an even better result with some of the, with a solution tied together with private equity in that asset allocation fund. So could see some really interesting things going forward as these products continue to get developed and private markets continue to get adopted.
Yeah, it'll be interesting to see how that does develop. All right, now to close us out, if you had one final message or takeaway for advisors and plan sponsors about alternatives in 401ks, what would it be?
So, if I could leave advisors and plan sponsors with one key takeaway, it's this. Alternatives like private equity can bring meaningful diversification and return potential to 401k portfolios, but the focus should always be on what's best for participants. And as the regulatory environment evolves, it's critical for fiduciaries to stay informed, do their due diligence, and engage the right experts. Not every plan is ready to jump into private assets, and that's perfectly fine. What matters is that fiduciaries educate themselves about the options, the structures, and the implementation approaches so that decisions are made thoughtfully and in the best interest of participants. Those who start the evaluation process now will be, in our opinion, well positioned as the industry continues to shift.
Okay. Well, we at the 401k specialists, we've always been really big on participant outcomes. Well, you've both given us a lot to think about as the workplace retirement plan market begins to consider the potential integration of private equity investments within DC plans. Maura Reilly Kennedy and Michelle Rappa of Neuberger Berman, thanks for joining us today and sharing those insights on the 401k Specialist podcast.
Thank you.
Thanks, Brian.